Here we are, snow day number 2. And we're here for part 3 of the profit maximization series. And let me just remind you what we did in part 1 and part 2. In part 1 we talked about what profit is and how the firm's demand curve relates to the market demand curve. In part 2 we introduced the profit maximizing rule, and we practiced implementing it at a really high price, 15 cents a bottle, and then at a somewhat high price. And we worked first with tabular data and then with diagrams. And today, in the third part, we're going to talk about how a firm would deal with really low prices. What happens if production's not profitable and the firm is struggling to do the best thing in very, very difficult conditions? And this is what the book calls the shutdown exception, or the shutdown condition. So let's get back to Sun Bottles. And if, just in case you're wondering, Harriet's still here. She's relaxed, taking it easy. So here we are. But before we get to the question of how this firm will deal with this very, very low price, let's just backtrack a second, because I've had a few calls about profit maximization at this low, relatively low price of $0.076 a bottle. A couple people called and said, geez, Dr. Easton, is $18,600 really the only profit maximizing price? And no, it's not. It turns out that Sun Bottles could also produce at the next lower output level, 16,500 bottles. And if you check out the numbers, here's that possible output. Here's the price. Here's the average total cost, just slightly lower. Here's the profit per bottle. And the slightly higher profit per bottle times the slightly lower output level ends up getting us exactly the same profit, $148.80. Whereas that's also what we made if we produced 18,600 bottles. So there are actually two profit maximizing outputs in this situation. But why not choose to produce the higher of those two outputs, since you'd have the satisfaction of giving that 6th employee a job? So let's think about how Sun Bottles could handle a worsening of the situation in their market. Suppose the demand curve shifts in even further so that the price falls perhaps to so here's our new demand curve, D3, a new equilibrium price, let's say it's 5 cents. And then we'd have a new demand curve over here. And so this is the terrible condition that Sun Bottles finds itself in. Let's think about what's the best they can do. So here are the marginal and average cost curves again, and I've drawn in this new terrible reality, the price of only 5 cents a bottle. And if we followed the profit maximizing rule, right, we'd expand production until the spot where the marginal cost curve, this blue line, right, cuts the demand curve from below. So we're going to watch for the spot where marginal cost has risen to just equal this price of 5 cents. And if we look at the table of cost data, we'll see that that's going to correspond to a production level of 14,000. So let's check and see how Sun Bottles is doing at that production level. So here we're back with the tabular cost data, and we're going to think about the price of 5 cents and producing 14,000 and see how this company's doing. And to do that, we're going to use the shorthand formula we developed in the first part of the lecture. Price less average total cost, which gives us profit per unit, multiplied by quantity gives us total profit. So 0.05 is our price, and if we come up here we can see that average total cost is 0.067. So if we do the math, we've got minus 0.017, which is telling us that on average across these 14,000 bottles, Sun Bottles is losing 1.7 cents a bottle. And then if we want to find total profit, or in this case total loss, since total profit is going to be negative, we multiply by 14,000. So we discover, if we do that, that total profit is negative $238. And you're going to say, geez, Easton, that is too low. We should not be producing. But I want to remind you that what we're doing is thinking about profit maximization in the short run. And in the short run, you're committed to your fixed costs. And your fixed costs in this case are $300 a day, the lease payment on the factory. So if we shut down, if we produce 0 instead of 14,000 units, our losses would be bigger, $300 a day. So it's better to produce and make smaller profits in the short run. Now, of course, if you thought that this situation was going to continue in the long run, you'd sell the factory, you'd shutter it, somehow you'd try to get out from under your responsibilities here. But in the short run, producing's the right idea. So let's think about how Sun Bottles might handle an even worse situation. Suppose the price, the market price, falls all the way to 0.033 cents, so that Sun Bottles now faces this demand curve, labeled P4. If we were going to implement the profit maximizing rule, then we'd expand output until price equals marginal cost, and we discover that that would be true at a quantity of 10,800 bottles, right here. But we might ask ourselves, what's life like at such a low price? And it turns out that life is plenty grim. So let's figure profitability here. If the price is 0.033 and we're producing 10,800 bottles a day, we need to find our average total cost. It's 0.072. And then we need to find our average loss per bottle, and it's minus 0.039, and we need to multiply that by the number of bottles. And that would give us a loss of 421.20. And you got to question a manager who says the best we can do is to produce 10,800 bottles if the result is a loss of $421.20 a day. Because after all, just a minute ago we said that we could shut down and lose only $300 a day. So actually, in this situation, the best output is not 10,800 bottles a day. It is 0. So let's think about how we can take that possibility that we can do better by shutting down into consideration. So, in part 2, we said that the profit maximizing rule tells us to expand output as long as price is greater than or equal to marginal cost. And now what we need to add is an exception. We could call it the shutdown exception. And the shutdown exception says that you ought to do what the profit maximizing rule says unless price falls so low that it is below the minimum of the average variable cost curve. So anytime you're thinking about what a firm ought to do in the short run, you first implement the profit maximizing rule, and then you check to see if the shutdown exception should be invoked. You've got to check and look at that average variable cost curve. So in this case, we can see that the average variable cost curve is this heavy dotted line, and it's always above our new demand curve. So the shutdown exception would be invoked in this case. It'd tell us better to produce 0. Don't produce 10,800 bottles. So let's think about the intuition of the shutdown exception, and let's just review our decision at a price of 5 cents. And let's think about average variable cost in that setting. When the price was 5 cents, we produced 14,000. Here's our marginal cost, and here's our average variable cost. So the average variable cost was under the price. 0.046 is less than 0.05. That's telling us that by operating, we can cover all of our variable costs, the $640 that we pay to the 4 employees, and have something left over. And as a result, our losses, though big, were not as big as our fixed costs. So it made sense for us to operate. But once the price drops all the way to 0.033, 3.3 cents a bottle, you can see that average variable cost is now above price. The price is 0.033 and the average variable cost 0.044. So that's saying that we can't even cover the costs of employing our 3 employees by selling the bottles. So that's why our total profit, or in this case total loss, has now grown to be bigger than our fixed costs. And that's why we're better off producing zero. So that's it for me. I hope you've enjoyed the three-part lecture, and study for that midterm on Tuesday.